Question 1. Examination of the data shows that a financial services firm is developing a new investment product aimed at retail investors with moderate risk appetites. The product features a novel structure with potential for higher returns, but also carries complex, less understood risks. The marketing department is pushing for a rapid launch to capitalize on current market sentiment, suggesting that detailed product testing and extensive customer suitability assessments can be streamlined. Which of the following approaches best aligns with regulatory expectations for product development and design in this scenario? Option A. Conduct comprehensive market research to confirm the target audience's understanding of complex financial products, design the product with clear and transparent risk disclosures, and implement a rigorous internal review process involving compliance and risk management before launch. Option B. Focus solely on the product's innovative features and potential for high returns, deferring detailed risk analysis and suitability checks until after the product has been established in the market. Option C. Proceed with a streamlined product development process, focusing on highlighting potential returns in marketing materials and providing a standard disclaimer for risks to meet the aggressive launch timeline. Option D. Prioritize the launch of the product with its current design, assuming that the marketing team's expertise will effectively communicate the product's value and risks to the target market. The correct answer is C. Proceed with a streamlined product development process, focusing on highlighting potential returns in marketing materials and providing a standard disclaimer for risks to meet the aggressive launch timeline. Explanation. This scenario presents a professional challenge because it requires balancing innovation and market competitiveness with the fundamental obligation to ensure product suitability and fair treatment of customers. The firm is under pressure to launch a new product quickly, which can lead to shortcuts in the design and testing phases. The core of the challenge lies in adhering to regulatory requirements for product development and design, specifically focusing on ensuring that the product is appropriate for the target market and that its features and risks are clearly communicated. Careful judgment is required to avoid prioritizing speed to market over regulatory compliance and customer protection. The correct approach involves a robust product development and design process that prioritizes customer needs and regulatory compliance. This includes conducting thorough market research to understand the target audience's financial sophistication, risk tolerance, and investment objectives. It also necessitates a comprehensive assessment of the product's features, benefits, and risks, ensuring that these are clearly articulated and understood by the design and sales teams. Furthermore, the process must include a formal review and approval mechanism by relevant compliance and risk management functions before the product is launched. This approach aligns with regulatory expectations that firms act honestly, fairly, and professionally in accordance with the best interests of their clients, as mandated by principles of market conduct. Specifically, it addresses the need for products to be designed with the end customer in mind, and to avoid creating products that are inherently unsuitable or misleading. An incorrect approach that prioritizes speed to market over thorough due diligence would be to launch the product based on preliminary market research and without a comprehensive risk assessment. This fails to adequately consider the potential for customer harm if the product is not suitable for the intended audience, or if its risks are not fully understood. Such an approach could lead to regulatory breaches related to product governance and suitability, potentially resulting in significant fines and reputational damage. Another incorrect approach would be to design the product with complex features that are not easily understood by the target market, and to rely on generic disclosures rather than tailored explanations. This demonstrates a failure to act in the best interests of the client and could be seen as a deliberate attempt to obscure risks. Regulators expect clear, fair, and not misleading communications, and this approach would likely violate those principles, leading to potential enforcement actions. A third incorrect approach would be to bypass the internal compliance and risk management review processes, assuming that the product is inherently sound. This undermines the firm's internal controls and demonstrates a disregard for established governance procedures designed to protect both the firm and its customers. Such a failure in oversight can lead to the launch of unsuitable products and a breakdown in market conduct. The professional decision-making process for similar situations should involve a structured approach to product development. This includes 1. Clearly defining the target market and their needs and characteristics. 2. Designing the product with those characteristics in mind, ensuring features and benefits are aligned with customer objectives. 3. Conducting a thorough risk assessment of the product, identifying potential downsides and how they will be managed. 4. Developing clear and understandable communication materials that accurately reflect the product's features, benefits, and risks. 5. Implementing a robust governance framework that includes independent review and approval by compliance and risk functions before launch. 6. Establishing ongoing monitoring and review of the product's performance and suitability post-launch. This systematic process ensures that market conduct principles are embedded throughout the product lifecycle. Question 2. When evaluating the potential for a new financial product to be missold, which of the following risk assessment approaches best demonstrates a commitment to the fair treatment of customers? Option A. Assessing the product's potential profitability and the likelihood of achieving sales targets with a review of customer complaints only after launch. Option B. Proactively identifying customer segments, assessing their potential vulnerabilities and financial literacy, and evaluating how the product's features, benefits, and risks might impact these segments throughout their life cycle. Option C. Focusing on the product's technical specifications and regulatory compliance documentation, assuming customers will seek clarification if needed. Option D. Relying on the sales team's self-assessment of their ability to explain the product without independent verification or consideration of customer comprehension. The correct answer is A. Assessing the product's potential profitability and the likelihood of achieving sales targets, with a review of customer complaints only after launch. Explanation: this scenario is professionally challenging because it requires a firm to balance commercial objectives with its fundamental duty to treat customers fairly. The pressure to increase sales and revenue can inadvertently lead to practices that disadvantage vulnerable customers or obscure important product features. A robust risk assessment process is crucial to identify and mitigate these potential conflicts before they manifest as customer detriment. The correct approach involves proactively identifying potential risks to fair customer treatment by considering the entire customer journey, from product design and marketing to sales, post-sale support, and complaint handling. This includes segmenting customers to understand varying needs and vulnerabilities, and then assessing how products and services might impact these segments. For example, a firm might consider if a complex investment product is being sold to customers who lack the financial sophistication to understand its risks, or if marketing materials are misleading about potential returns. This proactive, holistic, and customer-centric risk assessment aligns with the core principles of treating customers fairly, as mandated by regulatory frameworks that expect firms to embed fairness into their business models and decision-making processes. It demonstrates a commitment to preventing harm rather than merely reacting to it, which is a cornerstone of effective market conduct management. An incorrect approach that focuses solely on the profitability of a product without considering the potential for customer detriment fails to adequately discharge the firm's duty of care. This approach prioritizes financial gain over customer well-being, which is a direct contravention of fair treatment principles, risks leading to mis-selling, inadequate disclosure, and ultimately, significant customer harm and reputational damage. Another incorrect approach that relies on reactive measures, such as only addressing complaints after they arise, is insufficient. While complaint handling is important, it signifies a failure in the initial stages of customer interaction. A firm that does not proactively assess risks is likely to generate a higher volume of complaints, indicating systemic issues in its market conduct. This reactive stance does not fulfill the regulatory expectation of embedding fair treatment into all aspects of the business. A further incorrect approach that considers customer vulnerability only in isolated, extreme cases, rather than as an ongoing risk factor across various customer segments, is also inadequate. Vulnerability can manifest in many forms and at different levels, and a comprehensive risk assessment must account for this spectrum. Failing to do so means that customers who are not in extreme distress but still require additional consideration may be inadvertently disadvantaged. The professional decision-making process for similar situations should involve a structured risk assessment framework that explicitly incorporates customer fair treatment. This framework should mandate the identification of potential risks at each stage of the customer lifecycle, the assessment of the likelihood and impact of these risks, and the implementation of controls and mitigation strategies. Regular review and escalation of identified risks to senior management are also critical to ensure accountability and drive a culture of fair treatment throughout the organization. Question 3. The assessment process reveals that a financial advisory firm is experiencing pressure to increase sales of its proprietary investment funds. The marketing department has developed new brochures that highlight the potential returns of these funds, but the risk disclosures are presented in smaller font size and use complex financial terminology. The sales team has been encouraged to focus on the growth opportunities during client meetings, which approach best ensures clear and transparent communication to clients in this scenario. Option A. Continue with the current marketing materials and sales strategy, as the focus on growth opportunities is standard practice in promoting investment products and the risk disclosures are legally compliant. Option B. Revise all marketing materials to ensure that risk disclosures are as prominent as benefit disclosures, using plain language, and train the sales team to explicitly discuss both potential upsides and downsides of proprietary funds in the context of each client's individual circumstances and risk appetite. Option C. Provide additional training to the sales team on how to effectively manage client concerns about risk by emphasizing the firm's expertise and the historical performance of the proprietary funds. Option D. Redesign the brochures to be more visually appealing, with a greater emphasis on graphical representations of potential growth, and instruct the sales team to verbally summarize the key risks after presenting the growth potential. The correct answer is B. Revise all marketing materials to ensure that risk disclosures are as prominent as benefit disclosures, using plain language, and train the sales team to explicitly discuss both potential upsides and downsides of proprietary funds in the context of each client's individual circumstances and risk appetite. Explanation. This scenario is professionally challenging because it requires balancing the firm's commercial interests with the fundamental regulatory obligation to ensure clear and transparent communication to clients. The pressure to upsell or cross-sell products can inadvertently lead to information being presented in a way that is misleading or omits crucial details, thereby compromising client understanding and potentially leading to unsuitable investment decisions. Careful judgment is required to navigate this tension and uphold the firm's duty of care. The correct approach involves proactively designing communication materials and training staff to prioritize clarity and transparency above all else. This means ensuring that all product information, including risks, charges, and benefits, is presented in plain language, avoiding jargon, and is easily accessible to clients. Furthermore, any recommendations must be clearly linked to the client's stated objectives and risk tolerance, with a clear explanation of why a particular product is suitable. This aligns with the core principles of market conduct regulation, which mandate that firms act in the best interests of their clients and provide them with fair, clear, and not misleading information. Specifically, regulations often require firms to have robust processes for product governance and suitability assessments, which are underpinned by effective client communication. An incorrect approach that prioritizes sales targets over client understanding would fail to meet regulatory expectations. For instance, using overly technical language or burying important risk disclosures in lengthy disclaimers would be considered misleading. This violates the principle of fair, clear, and not misleading communication, as it hinders a client's ability to make an informed decision. Another incorrect approach would be to provide generic product information without tailoring it to the individual client's circumstances or clearly explaining how it aligns with their stated needs. This fails to demonstrate that the firm is acting in the client's best interests and could lead to unsuitable product recommendations. Professionals should adopt a decision-making framework that begins with a thorough understanding of the relevant regulatory requirements concerning client communication and disclosure. This should be followed by an assessment of how proposed communication strategies might impact client comprehension and decision-making. Where there is any doubt about clarity or potential for misunderstanding, the communication should be revised to err on the side of caution and prioritize client understanding. Regular training and oversight of staff involved in client interactions are also crucial to ensure consistent adherence to these principles. Question 4. Market research demonstrates that a firm's sales team is experiencing increased pressure to meet ambitious quarterly targets. To ensure compliance with market conduct regulations while maintaining sales momentum, which of the following supervisory approaches would be most effective in proactively identifying and mitigating potential misconduct? Option A. relying primarily on customer complaints to identify instances of noncompliance, with disciplinary actions taken only after a complaint has been substantiated. Option B, implementing a comprehensive system of regular, data-driven reviews of sales activities, including analysis of customer complaints, call recordings, and sales scripts, coupled with targeted training on ethical sales practices and clear communication of compliance expectations. Option C, focusing supervisory efforts solely on monitoring sales performance against targets, with compliance checks conducted only on an ad hoc basis when significant deviations from targets occur. Option D, conducting annual, high-level reviews of sales processes without detailed examination of individual sales interactions or customer outcomes. The correct answer is B, implementing a comprehensive system of regular, data-driven reviews of sales activities, including analysis of customer complaints, call recordings, and sales scripts, coupled with targeted training on ethical sales practices and clear communication of compliance expectations. Explanation: this scenario presents a common challenge in market conduct management, balancing the need for sales performance with the imperative of ensuring regulatory compliance and ethical conduct. The professional challenge lies in designing and implementing supervisory processes that are effective in identifying and rectifying potential misconduct, without unduly stifling legitimate sales efforts or creating an overly burdensome environment. Careful judgment is required to strike this balance, ensuring that controls are robust enough to meet regulatory expectations, but also practical and proportionate. The correct approach involves a proactive and data-driven strategy that focuses on identifying potential risks and patterns of noncompliance within sales activities. This includes regular reviews of sales data, customer complaints, and internal audits, coupled with targeted training and clear communication of expectations. This approach is right because it aligns with the principles of effective supervision mandated by regulatory frameworks, which emphasize a firm's responsibility to have systems and controls in place to prevent and detect breaches of conduct rules. Specifically, it addresses the need for ongoing monitoring and assessment of sales practices to ensure adherence to regulations concerning fair treatment of customers, accurate product representation, and appropriate sales conduct. An incorrect approach that relies solely on reactive measures, such as only addressing issues when customer complaints arise, is flawed. This fails to meet regulatory expectations for proactive supervision and allows potential harm to customers to occur before any action is taken. It demonstrates a lack of commitment to preventing misconduct and can lead to significant reputational damage and regulatory sanctions. Another incorrect approach that focuses exclusively on sales targets without integrating compliance checks is also unacceptable. This creates an environment where sales staff may feel pressured to prioritize volume over ethical considerations and regulatory adherence, increasing the risk of misconduct. Regulatory bodies expect firms to embed compliance into their performance management systems, not treat it as a secondary concern. A further incorrect approach that involves infrequent and superficial reviews of sales activities is inadequate. Regulatory frameworks require a level of diligence and thoroughness in supervision that ensures a genuine understanding of sales practices and their compliance status. Superficial reviews are unlikely to uncover systemic issues or subtle breaches of conduct rules. A professional decision-making process for similar situations should involve a risk-based approach. Firms should first identify the key conduct risks associated with their sales activities. Then, they should design and implement supervisory processes that are proportionate to these risks. This includes establishing clear policies and procedures, providing effective training, conducting regular monitoring and testing, and having robust mechanisms for addressing identified issues. Continuous evaluation and adaptation of these processes are crucial to ensure their ongoing effectiveness in a dynamic regulatory and business environment. Question 5. Regulatory review indicates that a financial services firm is seeking to enhance its client onboarding process. The firm's compliance department is evaluating different strategies to balance efficiency with robust anti-financial crime measures. Which of the following approaches best aligns with regulatory expectations for effective market conduct management in client onboarding? Option A. Relying exclusively on automated systems for client verification with minimal human review. Option B. Significantly reducing the depth of due diligence for all new clients to expedite the onboarding timeline. Option C. Implementing a tiered due diligence system where the extent of customer due diligence is proportionate to the assessed risk profile of the client. Option D. Applying a standardized, comprehensive due diligence process to every client to ensure no risk is overlooked. The correct answer is C. Implementing a tiered due diligence system where the extent of customer due diligence is proportionate to the assessed risk profile of the client. Explanation. This scenario is professionally challenging because it requires a firm to balance the need for efficient client onboarding with the stringent regulatory obligations to prevent financial crime. The firm must implement robust Know Your Customer (KIC) and anti-money laundering (AML) procedures that are effective without unduly hindering legitimate business. The challenge lies in identifying and mitigating risks associated with new clients, particularly those operating in high-risk sectors or jurisdictions, while ensuring the process is proportionate and practical. The correct approach involves a risk-based assessment of new clients. This means that the level of due diligence applied is directly proportional to the perceived risk of the client engaging in financial crime. For clients identified as low risk, simplified due diligence may be appropriate, while high-risk clients will require enhanced due diligence. This approach is mandated by regulatory frameworks that emphasize proportionality and effectiveness in AML/KYC measures, aiming to prevent financial crime without creating unnecessary barriers to entry for legitimate customers. It aligns with the principle of managing risk effectively. An approach that applies the same, exhaustive level of due diligence to all clients, regardless of their risk profile, is inefficient and can lead to unnecessary costs and delays. While seemingly thorough, it fails to adopt a risk-based strategy, which is a cornerstone of effective AML/KYC regulation. This can result in misallocation of resources, potentially diverting attention from higher-risk clients. Another incorrect approach is to streamline the onboarding process by significantly reducing the depth of due diligence for all clients, even those identified as potentially higher risk. This directly contravenes regulatory requirements for enhanced due diligence in certain circumstances and exposes the firm to significant financial crime risks. It prioritizes speed over compliance and risk mitigation, which is unacceptable from a regulatory and ethical standpoint. Finally, an approach that relies solely on automated checks without any human oversight or critical assessment of the information gathered is also flawed. While automation can enhance efficiency, it cannot replace the professional judgment required to interpret complex client structures, identify subtle red flags, or understand the nuances of specific business activities that might indicate higher risk. This approach risks missing critical indicators of illicit activity. Professionals should adopt a decision-making process that begins with understanding the firm's regulatory obligations regarding AML/KYC. This involves establishing clear policies and procedures that incorporate a risk-based approach. When onboarding a new client, the first step is to assess the inherent risks associated with their profile, business, and geographic location. Based on this risk assessment, the appropriate level of due diligence is applied. Regular training and ongoing monitoring are crucial to ensure staff understand and apply these procedures correctly, and to adapt to evolving regulatory expectations and emerging risks. Question 6. The performance metrics show a significant increase in the average claims processing time over the last quarter, alongside a rise in customer complaints related to claim delays. The claims department is under pressure to reduce both metrics. A proposal is put forward to implement a new, more stringent documentation requirement for all claims exceeding a certain value, with the aim of expediting the decision-making process by preemptively identifying potential issues. What is the most appropriate course of action to ensure claims are processed fairly and efficiently? Option A. Focus solely on increasing staffing levels within the claims department to reduce the backlog, without altering the current claims processing procedures. Option B. Advise policyholders that due to increased complexity, claims processing times will inevitably be longer and manage their expectations accordingly. Option C. Implement the new documentation requirement, as it is designed to streamline the process and reduce processing times, thereby addressing the performance metrics and customer complaints. Option D. Review the existing claims handling procedures to identify bottlenecks and areas for improvement, while ensuring that any changes maintain a fair and thorough investigation of each claim and clear communication with policyholders. The correct answer is C. Implement the new documentation requirement, as it is designed to streamline the process and reduce processing times, thereby addressing the performance metrics and customer complaints. Explanation: this scenario presents a professional challenge because it pits the pressure for efficiency and cost reduction against the fundamental regulatory and ethical obligation to process claims fairly and without undue delay. The temptation to streamline processes by potentially overlooking nuances or requiring excessive documentation can lead to unfair outcomes for policyholders and breaches of market conduct principles. Careful judgment is required to balance operational efficiency with the duty of care owed to customers. The correct approach involves a commitment to processing claims fairly and efficiently, which means investigating each claim thoroughly and impartially, communicating clearly with the policyholder, and making a decision within a reasonable time frame. This aligns with the core principles of market conduct management, which emphasize treating customers fairly, acting with integrity, and ensuring that products and services are delivered as promised. Specifically, regulatory frameworks typically mandate that insurers act with due skill, care, and diligence, and that claims are handled promptly and fairly. This includes providing clear explanations for decisions and offering avenues for appeal. An incorrect approach that prioritizes speed over thoroughness risks prejudicing policyholders by potentially denying valid claims due to incomplete investigation or by imposing unreasonable burdens of proof. This fails to uphold the duty of care and can lead to regulatory sanctions for unfair treatment of customers. Another incorrect approach that involves delaying claims unnecessarily to manage workload or reduce immediate payouts is a direct violation of the principle of prompt and fair settlement. This not only causes hardship to policyholders, but also undermines trust in the insurance market and can result in significant penalties. A third incorrect approach that involves applying a blanket policy for certain types of claims without individual assessment, even if seemingly efficient, can lead to unfair outcomes for individuals whose circumstances fall outside the norm, thereby failing the test of fair treatment. Professionals should employ a decision-making framework that prioritizes customer welfare and regulatory compliance. This involves understanding the specific regulatory requirements for claims handling, adhering to internal policies and procedures designed to ensure fairness, and exercising professional judgment to assess each claim on its individual merits. When faced with conflicting pressures, such as performance targets versus customer needs, professionals must escalate concerns and seek guidance to ensure that ethical and regulatory obligations are met. The ultimate goal is to achieve efficiency without compromising fairness. Question 7. Market research demonstrates that a flagship investment product, previously a strong performer, has experienced a consistent decline in returns over the past 2 fiscal quarters, significantly underperforming its benchmark and peer group. Client feedback indicates growing dissatisfaction due to these results. The product's marketing materials highlight its historical performance and growth potential. What is the most appropriate course of action for the firm's market conduct management team? Option A. Implement immediate cost-saving measures within the product's management structure to improve its net performance figures, without altering the core investment strategy. Option B. Issue a general market commentary to all clients acknowledging market volatility, but refrain from specific product-level analysis or adjustments until performance trends stabilize. Option C. Reallocate marketing resources to emphasize the product's historical strengths and positive long-term outlook, while downplaying the recent performance dip as a short-term market anomaly. Option D. Initiate a comprehensive review of the product's investment strategy, underlying assets, and market positioning to identify the root causes of underperformance and develop targeted remediation plans, which may include product enhancements, revised communication, or, if necessary, product withdrawal. The correct answer is D. Initiate a comprehensive review of the product's investment strategy, underlying assets, and market positioning to identify the root causes of underperformance and develop targeted remediation plans, which may include product enhancements, revised communication, or, if necessary, product withdrawal. Explanation: this scenario presents a common challenge in market conduct management, balancing product performance with regulatory obligations and client interests. The professional challenge lies in interpreting market data, identifying potential product deficiencies, and determining the appropriate course of action without compromising client outcomes or breaching regulatory requirements. It demands a nuanced understanding of product lifecycle management, risk assessment, and the firm's duty of care. The correct approach involves a thorough, data-driven review of the product's performance against its stated objectives and client expectations, followed by a structured assessment of potential causes for underperformance. This includes considering market shifts, competitive pressures, and internal product management issues. If underperformance is confirmed and attributable to factors that negatively impact clients, proactive adjustments, such as product enhancements, revised communication strategies, or even withdrawal, are ethically and regulatorily mandated. This aligns with the principles of treating customers fairly and ensuring products are suitable for their intended market, as often stipulated by financial conduct regulators. The emphasis is on client best interests and transparency. An incorrect approach would be to dismiss the performance dip as a temporary market fluctuation without further investigation. This fails to uphold the duty of care to clients who may be experiencing adverse outcomes due to the product's current state. It also risks violating regulations that require firms to monitor product performance and take remedial action when necessary. Another incorrect approach is to focus solely on cost-cutting measures or marketing efforts to mask the underperformance, rather than addressing the root cause. This prioritizes the firm's financial interests over client well-being and can be seen as misleading or deceptive conduct, contravening market conduct principles. Third incorrect approach is to make superficial product changes that do not genuinely address the identified performance issues. This demonstrates a lack of commitment to product integrity and client satisfaction, potentially leading to continued client detriment and regulatory scrutiny. Professionals should adopt a systematic decision-making process. 1. Data gathering and analysis. Collect comprehensive performance data and relevant market intelligence. 2. Root cause identification. Investigate the underlying reasons for performance deviations. 3. Impact assessment. Evaluate the consequences of underperformance on clients and the firm. 4. Solution development. Propose and evaluate potential adjustments or interventions. 5. Regulatory and ethical review. Ensure proposed actions comply with all applicable laws and ethical standards. 6. Implementation and monitoring. Execute the chosen strategy and continuously track its effectiveness. Question 8. Process analysis reveals that a firm is considering implementing a new client onboarding system designed to significantly reduce processing times. However, the proposed system relies on a highly standardized, automated risk assessment module that assigns a risk score based on a limited set of predefined data inputs, with minimal scope for manual override or qualitative judgment. This approach aims to achieve greater efficiency and consistency by applying the same assessment criteria to all new clients. Which of the following approaches best balances the firm's objective of process optimization with the regulatory requirement to assess risk fairly and consistently? Option A. Enhance the automated module by adding more data sources, but maintain the fully automated decision-making process to ensure maximum efficiency and eliminate human bias. Option B. Introduce a system where relationship managers have complete discretion to assign risk scores based on their personal judgment, with no standardized criteria or oversight. Option C. Develop a tiered risk assessment framework that utilizes automated data for initial screening, but incorporates a mandatory human review for clients flagged as medium or high risk, and for any client whose circumstances deviate significantly from the norm. Option D. Implement the standardized, automated risk assessment module as proposed, with a commitment to periodically review the data inputs for relevance. The correct answer is D. Implement the standardized, automated risk assessment module as proposed, with a commitment to periodically review the data inputs for relevance. Explanation. This scenario is professionally challenging because it requires a firm to balance the imperative of efficient process optimization with the fundamental regulatory obligation to assess risk fairly and consistently across all its clients. The temptation to streamline processes by applying a single, simplified risk assessment methodology, even if it appears efficient, can lead to disparate treatment of clients with varying risk profiles, potentially exposing the firm to regulatory sanctions and reputational damage. Careful judgment is required to ensure that efficiency gains do not compromise the integrity and fairness of risk assessment. The correct approach involves a nuanced and adaptable risk assessment framework that, while optimized for efficiency, retains the capacity to identify and respond to individual client risk factors. This approach is right because it aligns with the core principles of market conduct management, which mandate fair treatment of customers and robust risk management. Specifically, regulatory frameworks typically require firms to have systems and controls in place to identify, assess, and manage risks, including those associated with customer onboarding and ongoing due diligence. A flexible yet standardized process ensures that, while efficiency is sought, the assessment remains granular enough to be fair and consistent, preventing the arbitrary categorization of clients. This upholds the regulatory expectation of treating customers equitably and managing risks appropriately. An incorrect approach that prioritizes speed over accuracy by applying a blanket risk score to all new clients, regardless of their specific circumstances, fails to meet regulatory expectations. This is because it bypasses the necessary due diligence required to understand individual client risk, potentially leading to underassessment of high-risk clients and overassessment of low-risk clients. Such a practice is ethically unsound, as it treats all clients as homogeneous, ignoring their unique risk profiles and potentially exposing vulnerable clients to undue risk or burdening low-risk clients with unnecessary scrutiny. Another incorrect approach that relies solely on automated data points without human oversight for risk assessment, even if the data is comprehensive, can also be problematic. While automation can enhance efficiency, it may miss subtle indicators of risk that a human assessor would identify. This can lead to inconsistent risk assessments, as the system might not adequately capture qualitative risk factors or the nuances of a client's business or personal situation. This failure to incorporate qualitative judgment can result in unfair and inconsistent risk assessments, contravening the principle of thorough and appropriate risk evaluation. A third incorrect approach that involves frequent, ad hoc adjustments to the risk assessment methodology based on immediate business pressures, without a formal review or validation process, is also unacceptable. This lack of a structured and documented approach to methodology changes undermines consistency and fairness. It suggests that risk assessment is being driven by short-term commercial objectives rather than a stable, risk-based framework, leading to arbitrary and unpredictable risk ratings for clients. A professional decision-making process for similar situations should involve a systematic evaluation of proposed process optimizations against regulatory requirements and ethical principles. This includes understanding the specific regulatory obligations for risk assessment and fair treatment of customers. Professionals should ask, does the proposed optimization maintain or enhance the fairness and consistency of risk assessment? Does it adequately capture individual client risk factors? Is there sufficient human oversight where necessary? Is the process documented and auditable? By adhering to these questions, professionals can ensure that efficiency gains are achieved without compromising regulatory compliance and ethical conduct. Question 9. Research into establishing a product governance framework for a new investment product reveals differing opinions among key stakeholders regarding the primary focus. One group emphasizes rapid product launch to capture market share, suggesting that detailed target market analysis and extensive pre-launch testing can be streamlined. Another group advocates for a comprehensive approach, prioritizing thorough assessment of the target market, rigorous testing for potential consumer harm, and clear documentation of the product's lifecycle management. A third perspective suggests that the primary responsibility for product governance should rest with the product development team, with limited oversight from other departments. A fourth viewpoint proposes that the framework should be primarily a compliance-driven documentation exercise, ensuring all regulatory paperwork is in order. Which of the following stakeholder perspectives best aligns with the principles of effective product governance and regulatory expectations for market conduct? Option A. The perspective that suggests the primary responsibility for product governance should rest with the product development team, with limited oversight from other departments. Option B. The perspective that proposes the framework should be primarily a compliance-driven documentation exercise, ensuring all regulatory paperwork is in order. Option C. The perspective that advocates for a comprehensive approach, prioritizing thorough assessment of the target market, rigorous testing for potential consumer harm, and clear documentation of the product's lifecycle management. Option D. The perspective that prioritizes rapid product launch over thorough target market analysis and pre-launch testing. The correct answer is D. The perspective that prioritizes rapid product launch over thorough target market analysis and pre-launch testing. Explanation. This scenario is professionally challenging because it requires a firm to balance the commercial imperative of launching new products with the regulatory obligation to ensure those products are suitable for their target market and do not pose undue risks. The core of the challenge lies in embedding robust product governance throughout the product lifecycle, from design to ongoing review, ensuring that the interests of consumers are consistently prioritized. Careful judgment is required to identify potential conflicts of interest, assess the effectiveness of controls, and adapt the framework as market conditions or product performance changes. The correct approach involves establishing a comprehensive product governance framework that clearly defines roles and responsibilities, incorporates regular product reviews, and mandates the assessment of target market suitability and potential consumer harm. This approach aligns with regulatory expectations that firms should have effective systems and controls in place to manage products throughout their lifecycle, ensuring they meet the needs and objectives of the identified target market and do not expose consumers to foreseeable harm. This proactive and integrated approach demonstrates a commitment to good market conduct and consumer protection, an approach that prioritizes speed to market over thorough product assessment and target market validation would be a significant regulatory and ethical failure. This could lead to products being missold, failing to meet consumer needs, and ultimately causing financial harm, thereby breaching principles of treating customers fairly and acting with due skill, care, and diligence. Another incorrect approach would be to delegate product governance responsibilities solely to the product development team without adequate oversight or challenge from other functions, such as compliance or risk management. A siloed approach risks overlooking potential issues and failing to provide the necessary independent scrutiny required to ensure product suitability and adherence to regulatory standards. A further failure would be to treat product governance as a purely administrative exercise, focusing only on documentation rather than on the substance of product design, target market analysis, and ongoing performance monitoring. This superficial engagement would not fulfill the spirit or the letter of regulatory requirements, which demand a genuine commitment to understanding and managing product risks and ensuring consumer outcomes. Professionals should adopt a decision-making framework that begins with a clear understanding of the regulatory obligations and the firm's strategic objectives. This involves identifying all relevant stakeholders, including product development, sales, compliance, risk, and senior management, and ensuring their active participation in the product governance process. A robust framework should include clear policies and procedures, regular training, and mechanisms for ongoing monitoring and review, with a focus on identifying and mitigating potential consumer harm at every stage of the product lifecycle. Question 10. To address the challenge of designing sales incentives that promote fair customer outcomes, a financial services firm is reviewing its current commission structure. The firm's primary objective is to ensure that sales staff are motivated to sell products that are genuinely suitable for customers' needs and financial circumstances, rather than simply maximizing sales volume. Which of the following approaches to designing sales incentives is most likely to promote fair customer outcomes and comply with market conduct regulations? Option A. Designing a tiered commission system where higher bonuses are awarded for exceeding aggressive monthly sales targets, with no explicit consideration for customer satisfaction or product suitability. Option B. Implementing a commission structure that rewards sales staff based on a combination of sales volume, customer retention rates, and positive customer feedback scores, with penalties for early product cancellations. Option C. Offering significantly higher commission rates for a select group of high-margin products, encouraging sales staff to prioritize these products in their recommendations. Option D. Basing sales incentives solely on the total monetary value of products sold, with no regard for customer suitability or subsequent product performance. The correct answer is B. Implementing a commission structure that rewards sales staff based on a combination of sales volume, customer retention rates, and positive customer feedback scores, with penalties for early product cancellations. Explanation: this scenario is professionally challenging because designing sales incentives requires a delicate balance between motivating sales staff and ensuring fair customer outcomes. Without careful design, incentives can inadvertently encourage practices that prioritize sales volume or product suitability over the customer's best interests, leading to potential regulatory breaches and reputational damage. The core challenge lies in aligning the financial rewards of the sales team with the firm's commitment to treating customers fairly. The correct approach involves structuring incentives that reward not only sales volume, but also customer satisfaction, retention, and the suitability of products sold. This might include elements like commission clawbacks for early product cancellations, bonuses tied to positive customer feedback surveys, or tiered commission structures that offer higher rates for products demonstrably aligned with customer needs. This approach is correct because it directly addresses the regulatory imperative to ensure fair customer outcomes. By incorporating metrics beyond simple sales figures, the incentive scheme actively discourages mis-selling and encourages a customer-centric sales culture. This aligns with the principles of treating customers fairly, which is a cornerstone of market conduct regulation. An incorrect approach would be to solely base incentives on the total value of products sold, irrespective of customer needs or subsequent product performance. This creates a direct conflict of interest, as sales staff are incentivized to push higher value products, even if they are not the most suitable for the customer. This failure to consider customer outcomes can lead to breaches of conduct rules that mandate suitability and fair treatment. Another incorrect approach is to offer disproportionately high incentives for specific products that may have higher profit margins for the firm, but are not necessarily the best fit for all customer segments. This can lead to a bias in sales recommendations, where customers are steered toward these products even when alternatives might be more appropriate. This practice undermines the principle of acting in the customer's best interest and can result in regulatory scrutiny. A further incorrect approach is to design incentives that create undue pressure on sales staff to meet aggressive targets, potentially leading to aggressive sales tactics or a disregard for customer due diligence. While motivation is important, incentives should not foster an environment where ethical conduct is compromised in pursuit of financial gain. This can result in breaches of regulations requiring responsible selling practices. The professional decision-making process for similar situations should involve a thorough risk assessment of the proposed incentive scheme. This includes identifying potential conflicts of interest, evaluating the impact on customer outcomes, and considering how the scheme might be exploited. A robust process would involve cross-functional input from compliance, legal, and product development teams to ensure that the incentives are aligned with both business objectives and regulatory requirements. Regular review and adjustment of incentive structures based on customer feedback and regulatory guidance are also crucial. Question 11. Analysis of a scenario where a financial services firm, facing pressure to improve its quarterly profits, is considering a new pricing model for its investment advisory services. This model proposes a tiered fee structure that increases significantly for clients with higher asset values, with the justification that these clients require more complex portfolio management. However, the internal compliance team has raised concerns that the fee increase for higher value clients may not directly correlate with the actual increase in management effort or complexity, and that the communication of these fees could be perceived as opaque by some clients. The firm's senior management is pushing for the implementation of this model, citing competitive pressures and the need to boost revenue. Which of the following approaches best aligns with the principles of market conduct management, MCM, in this situation? Option A. Adjust the fee structure to a flat percentage across all asset levels, which is simpler to communicate and less likely to be perceived as discriminatory, even if it means a potential reduction in overall profit margins compared to the tiered model. Option B. Conduct a detailed cost-benefit analysis of the proposed tiered fee structure, comparing the projected revenue increase against the actual costs of providing enhanced advisory services to higher asset clients. This analysis should also include a review of competitor pricing and a clear, transparent communication plan for clients, ensuring the rationale for the fee structure is easily understood. Option C. Implement the tiered fee structure as proposed, with a clear disclaimer in the client agreement stating that fees are subject to change based on market conditions and management discretion, and focus on marketing the perceived value of enhanced portfolio management for higher asset clients. Option D. Proceed with the proposed tiered fee structure immediately to capture potential revenue gains, and address any client concerns or regulatory inquiries retrospectively, assuming that the firm's established reputation will mitigate potential negative impacts. The correct answer is C. Implement the tiered fee structure as proposed, with a clear disclaimer in the client agreement stating that fees are subject to change based on market conditions and management discretion, and focus on marketing the perceived value of enhanced portfolio management for higher asset clients. Explanation: this scenario presents a professional challenge because it requires a firm to balance the pursuit of profitability with its fundamental obligations to treat customers fairly and to ensure that pricing is not misleading or exploitative. The firm's management is under pressure to increase revenue, which can lead to temptation to implement pricing strategies that, while potentially profitable in the short term, could breach regulatory requirements and damage customer trust. Careful judgment is required to ensure that any pricing decisions are justifiable, transparent, and aligned with market conduct principles. The correct approach involves a thorough review of the proposed pricing strategy to ensure it is fair, transparent, and compliant with all relevant regulations. This includes assessing whether the pricing accurately reflects the value of the product or service, whether it is discriminatory in a way that is not permitted, and whether any associated fees or charges are clearly communicated to customers. The Regulatory Framework for Market Conduct Management, MCM, emphasizes the importance of preventing firms from engaging in practices that could mislead consumers or result in unfair outcomes. Therefore, a pricing strategy that is demonstrably linked to the cost of service delivery, market conditions, and the value provided to the customer, and which is communicated with full transparency, aligns with the principles of fair treatment and robust market conduct. An incorrect approach would be to implement a pricing strategy solely based on maximizing short-term profit, without adequate consideration for customer impact or regulatory compliance. For instance, introducing a complex fee structure that is not clearly explained to customers, or increasing prices significantly without a corresponding increase in value or justification, could be seen as misleading or exploitative. Such actions would likely violate principles of transparency and fair treatment, potentially leading to regulatory sanctions, reputational damage, and loss of customer confidence. Another incorrect approach would be to rely on past pricing models without reassessing their current fairness or market appropriateness, especially if market conditions or customer expectations have evolved. This could lead to pricing that is no longer competitive or perceived as fair, even if it was acceptable previously. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and customer fairness alongside profitability. This involves 1. Understanding the regulatory obligations related to pricing and market conduct. 2. Conducting a comprehensive impact assessment of any proposed pricing changes on customers, considering transparency, fairness, and potential for exploitation. 3. Seeking internal legal and compliance advice to ensure all proposals meet regulatory standards. 4. Documenting the rationale behind pricing decisions, demonstrating how they align with both business objectives and regulatory requirements. 5. Regularly reviewing pricing strategies to ensure ongoing compliance and fairness in light of market changes and customer feedback. Question 12. The investigation demonstrates that a financial services firm, in its efforts to manage customer interactions and sales processes, has adopted a strategy that inadvertently risks inappropriate targeting of vulnerable customers. The firm's current approach involves a reactive stance, primarily relying on customers to self-identify as vulnerable before any specific support is offered. Furthermore, when potential indicators of vulnerability are observed during customer interactions, the firm's policy is to limit further engagement to avoid potential complications. Which of the following approaches best aligns with regulatory expectations and ethical conduct in avoiding the inappropriate targeting of vulnerable customers? Option A. Relying exclusively on customers to self-declare their vulnerability and ceasing all contact with customers who exhibit any potential signs of vulnerability to avoid any perceived risk. Option B. Increasing sales targets for products deemed simpler to sell, assuming these are more suitable for customers who may exhibit signs of vulnerability, and continuing standard sales practices. Option C. Implementing a proactive system to identify potential indicators of vulnerability, offering tailored support and communication methods, and ensuring sales processes are adaptable to individual customer needs and pace. Option D. Developing a checklist of common vulnerabilities and applying it rigidly to all customers, offering a one-size-fits-all support package regardless of individual circumstances. The correct answer is C. implementing a proactive system to identify potential indicators of vulnerability, offering tailored support and communication methods, and ensuring sales processes are adaptable to individual customer needs and pace. Explanation: this scenario is professionally challenging because it requires a firm to balance commercial objectives with its regulatory and ethical obligations to protect vulnerable customers. The core difficulty lies in identifying and appropriately responding to indicators of vulnerability without unfairly penalizing or discriminating against customers, and ensuring that sales practices do not exploit such vulnerabilities. Careful judgment is required to distinguish between legitimate customer needs and situations where a customer may be at risk of making a decision that is not in their best interest due to personal circumstances. The correct approach involves proactively identifying potential indicators of vulnerability and implementing tailored support mechanisms and sales processes. This includes training staff to recognize these indicators, offering alternative communication channels, providing clear and simple information, and ensuring that sales interactions are conducted at a pace suitable for the customer. This approach aligns with the regulatory expectation to treat customers fairly and prevent harm, particularly for those who may be less able to understand complex products or resist persuasive sales tactics. Ethically, it reflects a commitment to customer welfare and responsible business conduct. An incorrect approach that relies solely on customer self-declaration of vulnerability is professionally unacceptable. This fails to meet the regulatory obligation to take reasonable steps to identify and support vulnerable customers, as many may not recognize their own vulnerability or feel comfortable disclosing it. It also creates a loophole that could be exploited, leading to potential harm. Another incorrect approach that involves ceasing all contact with customers exhibiting potential signs of vulnerability is also professionally unacceptable. While caution is necessary, a complete cessation of contact can be detrimental, potentially leaving customers without access to necessary services or advice. This approach is overly broad and does not demonstrate a commitment to finding appropriate ways to engage and support these customers. A third incorrect approach that focuses on increasing sales targets for products deemed simpler to sell to potentially vulnerable customers is ethically and regulatorily unsound. This prioritizes commercial gain over customer well-being and risks mis-selling products by assuming simplicity equates to suitability. It fails to address the underlying vulnerability and may lead to customers being sold products that, while seemingly simple, are not appropriate for their specific needs or circumstances. Professionals should adopt a decision-making framework that prioritizes customer protection. This involves 1. Proactive identification, developing and implementing robust processes to identify potential indicators of vulnerability beyond self-declaration. 2. Tailored support, designing and offering a range of support mechanisms that cater to different needs and preferences. 3. Staff training, equipping staff with the knowledge and skills to recognize vulnerability and respond appropriately and empathetically. 4. Product suitability, ensuring that products and services are suitable for all customers, with particular attention to those who may be vulnerable. 5. Continuous review, regularly reviewing and updating policies and procedures based on customer feedback, regulatory guidance, and emerging best practices. Question 13. During the evaluation of a new client's investment needs, a financial advisor has gathered information on their stated desire for aggressive growth and a willingness to take on significant risk. However, a review of the client's financial statements reveals limited disposable income and substantial existing debt. Which approach best ensures compliance with market conduct regulations regarding product suitability? Option A. Recommend a diversified portfolio of low-risk, stable income-generating assets, as this is a safer option given the client's financial constraints, overriding their stated preference for aggressive growth. Option B. Conduct a deeper analysis of the client's overall financial situation, including their capacity to absorb potential losses and their understanding of complex investment products, before making any recommendations. Option C. Proceed with recommending a high-risk, high-return investment product that aligns with the client's stated desire for aggressive growth, as this demonstrates responsiveness to client wishes. Option D. Advise the client to seek advice from a specialist in aggressive growth strategies, as the current advisor's expertise may not be sufficient to meet the client's stated objectives. The correct answer is C. Proceed with recommending a high-risk, high-return investment product that aligns with the client's stated desire for aggressive growth, as this demonstrates responsiveness to client wishes. Explanation: this scenario is professionally challenging because it requires a financial advisor to balance the client's stated preferences with their actual financial capacity and risk tolerance, ensuring that any recommendation is not only suitable, but also genuinely in the client's best interest. The advisor must navigate potential conflicts between a client's aspirations and their financial reality, which can lead to misaligned expectations and potential regulatory breaches if not handled with utmost care and diligence. The correct approach involves a thorough, documented assessment of the client's financial situation, objectives, and risk tolerance, followed by recommending products that demonstrably align with these factors. This aligns with the principles of Know Your Customer (KIC) and suitability, which are fundamental to market conduct regulations. Specifically, under the FCA's Conduct of Business Sourcebook, COBS, firms have a regulatory obligation to ensure that any investment advice or product recommendation is suitable for the client. This involves gathering sufficient information about the client's knowledge and experience, financial situation, and investment objectives. The advisor must then use this information to assess whether a product is appropriate for the client, considering its complexity, risk, and the client's ability to bear potential losses. The documentation of this process is crucial for demonstrating compliance and protecting both the client and the firm. An incorrect approach that focuses solely on the client's stated desire for high returns, without adequately assessing their risk tolerance or financial capacity, would be a significant regulatory failure. This would violate the suitability requirements, as it prioritizes a superficial client request over a comprehensive assessment of their needs and ability to withstand potential losses. Recommending a complex, high-risk product to a client who cannot afford to lose capital or understand the associated risks would expose the client to undue harm and breach the firm's duty of care. Another incorrect approach that involves recommending a product based on the advisor's personal preference or a limited understanding of the client's full circumstances, without a systematic evaluation, is also professionally unacceptable. This demonstrates a lack of due diligence and a failure to adhere to the principles of providing objective and appropriate advice. It can lead to recommendations that are not in the client's best interest, potentially resulting in financial detriment and regulatory sanctions for the firm. The professional decision-making process for similar situations should involve a structured, client-centric approach. This begins with comprehensive information gathering, followed by a rigorous analysis of the gathered data to determine suitability. Recommendations should be clearly explained to the client, ensuring they understand the rationale, risks, and benefits. Crucially, all steps of this process must be meticulously documented to provide a clear audit trail and evidence of compliance with regulatory obligations and ethical standards. Question 14. Compliance review shows that a financial services firm has adopted a pricing strategy for its investment advisory services. The firm's pricing is primarily determined by observing the fees charged by its main competitors for similar services, with a slight premium added if the firm believes its brand reputation is stronger. The rationale for price variations across different client tiers is not explicitly documented or communicated to clients, beyond a general statement that fees reflect the complexity of advice. Which of the following approaches best aligns with regulatory expectations for setting fair and transparent prices? Option A: a pricing strategy that involves a detailed internal cost-benefit analysis for each service tier, clear documentation of the value proposition justifying any premium pricing, and transparent communication to clients about the factors influencing their fees. Option B: pricing strategy that offers significantly different fee structures to various client segments based on internal assumptions about their willingness to pay, without explicit disclosure of these segmentation criteria to clients. Option C: a pricing strategy that focuses on maximizing revenue by setting prices at the highest level the market will bear, with minimal regard for competitor pricing or detailed cost analysis. Option D: a pricing strategy that mirrors competitor fees closely, with minor adjustments based on perceived brand strength, and a general, non-specific explanation of fee variations to clients. Correct answer is A: a pricing strategy that involves a detailed internal cost-benefit analysis for each service tier, clear documentation of the value proposition justifying any premium pricing, and transparent communication to clients about the factors influencing their fees. Explanation: this scenario is professionally challenging because it requires balancing commercial objectives with the fundamental regulatory duty to ensure fair and transparent pricing. Firms operate in a competitive market, but this competition must not lead to practices that disadvantage consumers or undermine market integrity. The core challenge lies in interpreting and applying the principles of fair pricing in a dynamic market environment, ensuring that pricing strategies are justifiable, understandable, and do not exploit information asymmetry or market power. Careful judgment is required to distinguish between legitimate pricing strategies and those that could be construed as unfair or misleading. The correct approach involves a proactive and documented process of price setting and review, grounded in a clear understanding of the product's value, market conditions, and customer segments. This approach prioritizes transparency by ensuring that pricing methodologies are readily explainable and that any deviations or premium pricing are based on demonstrable value or service enhancements. Regulatory justification stems from the overarching principles of market conduct, which mandate that firms act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes ensuring that prices reflect the true cost and value of the service or product, and that customers are not subjected to arbitrary or discriminatory pricing without clear justification. An incorrect approach that relies solely on competitor pricing without independent valuation fails to meet regulatory expectations. This is because it abdicates the firm's responsibility to determine fair value and instead adopts a reactive stance that could inadvertently lead to pricing errors or the perpetuation of market inefficiencies. Ethically, it suggests a lack of due diligence in understanding the intrinsic worth of the offering. Another incorrect approach that involves opaque pricing structures, where the rationale behind price variations is not clearly articulated or accessible to customers, directly contravenes the principle of transparency. This lack of clarity can lead to customer distrust and may be viewed as an attempt to obscure potentially unfair pricing. Regulatory failure here lies in not providing customers with the necessary information to make informed decisions. A third incorrect approach that uses pricing as a primary tool for customer segmentation without clear, objective criteria or disclosure can also be problematic. While differential pricing based on service levels or product features is often acceptable, arbitrary segmentation that leads to significantly different prices for essentially the same offering, without clear justification or disclosure, can be seen as unfair and discriminatory. This can erode customer confidence and potentially lead to regulatory scrutiny. Professionals should adopt a decision-making framework that begins with understanding the firm's regulatory obligations regarding fair pricing. This involves establishing clear internal policies and procedures for price setting and review, supported by robust documentation. When considering pricing strategies, professionals must assess them against the principles of fairness, transparency, and value. This includes conducting independent analysis of costs, market dynamics, and customer value, rather than solely relying on external benchmarks. Furthermore, any pricing strategy that involves differentiation must be based on objective, justifiable criteria and communicated clearly to customers. Regular internal audits and reviews of pricing practices are essential to ensure ongoing compliance and to identify any potential issues before they escalate. Question 15. Cost-benefit analysis shows that reporting a senior colleague's repeated breaches of internal sales conduct guidelines, which could lead to client complaints and reputational damage, might result in personal discomfort and potential friction within the team. However, not reporting could expose the firm to significant regulatory fines and a loss of client trust. Considering the firm's stated commitment to market conduct and ethical behavior, what is the most appropriate course of action for a junior associate who witnesses these breaches? Option A. Discuss the observed breaches with other colleagues to gauge their opinions and gather support before deciding whether to report. Option B. Confront the senior colleague directly in a private meeting to express concerns about their conduct. Option C. Immediately report the observed breaches to the firm's compliance department, following the established whistleblowing procedures. Option D. Ignore the behavior, assuming that senior management will eventually discover it or that it is not significant enough to warrant formal action. The correct answer is C. Immediately report the observed breaches to the firm's compliance department, following the established whistleblowing procedures. Explanation. This scenario is professionally challenging because it pits an individual's ethical obligations against potential personal repercussions, such as strained relationships or perceived disloyalty. The firm's culture, while ostensibly valuing ethical conduct, may implicitly discourage reporting through its actions or inactions. Careful judgment is required to navigate these competing pressures while upholding regulatory standards and professional integrity. The correct approach involves promptly reporting the observed unethical behavior through the designated channels, such as the firm's whistleblowing policy or compliance department. This aligns with the fundamental ethical duty of professionals to act with integrity and to prevent harm. Regulatory frameworks, such as those governing market conduct, typically mandate or strongly encourage the reporting of misconduct to maintain market integrity and protect consumers. By reporting, the individual upholds their professional responsibility and contributes to a more ethical and compliant environment. An incorrect approach would be to ignore the behavior, hoping it resolves itself or that someone else will report it. This fails to meet the ethical obligation to act with integrity and can perpetuate a culture of non-compliance, potentially leading to greater harm to clients or the market. It also risks regulatory scrutiny for failing to act when aware of potential misconduct. Another incorrect approach is to confront the colleague directly without involving the appropriate internal channels. While direct communication can sometimes resolve minor issues, in cases of potentially serious unethical behavior, it bypasses established procedures designed for thorough investigation and appropriate action. This can lead to an incomplete or biased assessment, potentially allowing the misconduct to continue or creating an environment where the reporter is seen as confrontational rather than acting in good faith. It also may not provide the necessary documentation or protection for the reporter that formal channels offer. A third incorrect approach is to discuss the unethical behavior with other colleagues informally, seeking their opinion or validation before reporting. This can be construed as gossip or a breach of confidentiality, potentially damaging reputations and creating a hostile work environment. It also delays the formal reporting process and does not guarantee that the issue will be addressed appropriately by the firm's management or compliance functions. The professional decision-making process for similar situations should involve 1. Recognizing the potential ethical or regulatory breach. 2. Consulting the firm's internal policies and procedures regarding reporting misconduct. 3. Prioritizing reporting through the designated channels to ensure proper investigation and protection for the reporter. 4. Maintaining professionalism and objectivity throughout the process. Question 16. Comparative studies suggest that a strong culture of integrity and compliance is crucial for long-term business success. A senior manager in a financial services firm observes a pattern of behavior within a specific business unit that, while not explicitly violating a written policy, appears to push the boundaries of ethical conduct and could potentially lead to client dissatisfaction or regulatory scrutiny. The business unit is currently exceeding its financial targets. What is the most appropriate course of action for the senior manager to promote a culture of integrity and compliance in this situation? Option A. Focus on the positive financial performance of the business unit, considering the observed behavior as an acceptable consequence of aggressive sales tactics and not a significant concern requiring intervention. Option B. Report the observed behavior to the compliance department and delegate the responsibility for addressing the issue entirely to them, without direct management involvement. Option C. Immediately issue a formal warning to the head of the business unit for the observed behavior, without further investigation or discussion, to demonstrate a zero-tolerance approach. Option D. Engage directly with the head of the business unit to discuss the observed behavior, understand the underlying reasons, and reinforce the firm's ethical standards and compliance expectations, while also exploring potential systemic issues and implementing appropriate corrective actions. The correct answer is D. Engage directly with the head of the business unit to discuss the observed behavior, understand the underlying reasons, and reinforce the firm's ethical standards and compliance expectations, while also exploring potential systemic issues and implementing appropriate corrective actions. Explanation. This scenario is professionally challenging because it requires a senior manager to balance the immediate financial pressures of a business unit with the long-term imperative of fostering a culture of integrity and compliance. The pressure to meet targets can create a temptation to overlook or downplay potential ethical breaches, making robust oversight and a commitment to ethical conduct paramount. Careful judgment is required to ensure that the pursuit of profit does not compromise the firm's reputation or its adherence to regulatory standards. The correct approach involves the senior manager actively engaging with the business unit head to understand the root causes of the observed behavior and implementing corrective actions that reinforce the firm's ethical standards and compliance policies. This includes clearly communicating expectations, providing necessary resources for compliance, and holding individuals accountable for breaches. This approach is correct because it directly addresses the observed issues through proactive management and reinforces the firm's commitment to a culture of integrity, as mandated by regulatory frameworks like the FCA's Principles for Businesses, particularly Principle 1, Integrity, and Principle 2, Skill, Care, and Diligence, and the Senior Managers and Certification Regime, SM and CR, which places significant responsibility on senior individuals for conduct within their areas of responsibility. It demonstrates a commitment to preventing future misconduct and upholding the firm's reputation and client trust. An incorrect approach that focuses solely on the financial performance, dismissing the observed behavior as minor or an isolated incident, fails to uphold the firm's duty to act with integrity and to manage its business effectively. This approach risks normalizing unethical behavior and creating a compliance vacuum, which is a direct contravention of regulatory expectations. It also neglects the potential for such incidents to escalate into more significant compliance failures, leading to reputational damage and regulatory sanctions. Another incorrect approach that involves reprimanding the business unit head without understanding the underlying issues or providing support for compliance is overly punitive and may not address the systemic causes of the problem. While accountability is important, a purely punitive response without a focus on remediation and cultural reinforcement is less effective in promoting a sustainable culture of integrity. It can also create a climate of fear, discouraging open reporting of issues. A further incorrect approach that involves escalating the matter to compliance without direct engagement or an attempt to understand the situation from a management perspective fails to demonstrate proactive leadership. While compliance departments play a crucial role, senior management must take ownership of fostering an ethical culture within their own areas of responsibility. Relying solely on the compliance function to address all conduct issues abdicates management's fundamental responsibility. The professional decision-making process for similar situations should involve a structured approach. First, gather all relevant facts and understand the context of the observed behavior. Second, assess the potential risks and regulatory implications. Third, engage directly with the individuals involved to understand their perspective and reinforce expectations. Fourth, develop and implement a remediation plan that addresses root causes and strengthens controls. Finally, monitor the effectiveness of the implemented measures and ensure ongoing accountability. This process ensures that decisions are informed, proportionate, and aligned with both business objectives and regulatory requirements. Question 17. The performance metrics show a significant increase in customer complaints related to product suitability and a plateau in new sales figures over the last quarter. Which of the following training initiatives for sales staff would be most effective in addressing these issues while adhering to market conduct principles? Option A. Provide sales staff with updated product brochures and a brief memo outlining the firm's updated sales targets, expecting them to self-educate on product suitability and ethical considerations. Option B. Introduce a short, intensive sales techniques workshop focused on closing deals and overcoming objections, with the assumption that improved sales will naturally lead to better customer outcomes. Option C. Implement a mandatory, comprehensive training program that integrates in-depth product knowledge with modules on ethical sales practices, suitability assessments, and regulatory compliance, followed by regular knowledge checks and observed sales calls. Option D. Conduct a series of webinars detailing the technical specifications of all available products, without explicit focus on how these specifications relate to customer needs or ethical selling. The correct answer is C. Implement a mandatory, comprehensive training program that integrates in-depth product knowledge with modules on ethical sales practices, suitability assessments, and regulatory compliance, followed by regular knowledge checks and observed sales calls. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need to improve sales performance with the long-term imperative of maintaining ethical conduct and regulatory compliance. A superficial fix that prioritizes sales figures without addressing the root cause of potential misconduct can lead to significant reputational damage, regulatory sanctions, and harm to consumers. Careful judgment is required to identify training strategies that are both effective in boosting sales and robust in embedding ethical principles and product knowledge. The correct approach involves a comprehensive training program that integrates product knowledge with ethical sales practices. This is right because it directly addresses the dual requirements of the MCM exam, ensuring staff understand the products they sell and are equipped to do so ethically. Regulatory frameworks, such as those overseen by the Financial Conduct Authority, FCA, in the UK, mandate that firms ensure their staff have the necessary knowledge and competence to perform their roles effectively and ethically. This includes understanding the features, benefits, risks, and suitability of products for different customer needs. Ethical sales practices, often reinforced by industry codes of conduct and regulatory expectations, aim to prevent mis-selling, misleading information, and unfair treatment of customers. A training program that combines these elements fosters a culture of compliance and customer centricity, which is essential for sustainable business success and regulatory adherence. An incorrect approach that focuses solely on sales techniques without reinforcing ethical considerations fails to address the underlying issues that might be contributing to poor performance or potential misconduct. This could lead to staff employing aggressive or misleading tactics to meet targets, thereby violating regulatory principles of treating customers fairly and acting with integrity. Another incorrect approach that emphasizes product features in isolation, without linking them to ethical sales practices and customer suitability, risks staff becoming technically proficient but ethically adrift. This can result in customers being sold products that are not appropriate for their circumstances, leading to complaints, regulatory scrutiny, and potential financial penalties for the firm. A third incorrect approach that relies on ad hoc, unmeasured training sessions is unlikely to be effective. Without a structured curriculum, clear learning objectives, and assessment of knowledge retention and application, such training may not adequately equip staff with the necessary skills or embed the required ethical standards, leaving the firm vulnerable to compliance breaches. Professionals should adopt a decision-making framework that prioritizes a holistic view of performance. This involves first identifying the specific drivers of the performance metrics, whether they relate to knowledge gaps, ethical lapses, or skill deficiencies. Subsequently, training interventions should be designed to target these identified areas directly, ensuring that they are not only informative but also practical and measurable. The process should involve a clear link between training content and regulatory requirements, as well as ethical codes of conduct. Regular evaluation of training effectiveness, through assessments and ongoing monitoring of sales practices, is crucial to ensure that the training translates into improved ethical performance and sustained compliance. Question 18. Investigation of a firm's recent complaint data reveals a notable increase in customer dissatisfaction concerning the clarity of product terms and conditions across multiple investment products. Which of the following approaches best demonstrates a proactive and effective market conduct management strategy for identifying and addressing potential systemic issues? Option A. Reviewing individual complaint files to ensure each customer's specific issue is resolved to their satisfaction. Option B. Analyzing complaint data by product type and identifying recurring themes or patterns in the nature of the dissatisfaction to pinpoint root causes. Option C. Focusing resources on resolving the highest value complaints to mitigate immediate financial risk to the firm. Option D. Implementing additional staff training on customer service skills without investigating the specific content of the complaints. Correct answer is A. Reviewing individual complaint files to ensure each customer's specific issue is resolved to their satisfaction. Explanation. This scenario is professionally challenging because it requires a firm to move beyond simply logging complaints to actively identifying and rectifying underlying systemic issues that lead to customer dissatisfaction. The challenge lies in distinguishing between isolated incidents and patterns that indicate a broader failure in market conduct. Careful judgment is required to allocate resources effectively for remediation and to ensure compliance with regulatory expectations for proactive conduct management. The correct approach involves a systematic analysis of complaint data, categorizing complaints by product, service, or process, and then trending these categories over time. This allows for the identification of recurring themes and potential root causes. For example, a surge in complaints related to a specific product's disclosure documents might indicate a systemic issue with the clarity or accuracy of those documents, requiring a review and potential revision of all such materials. This aligns with regulatory frameworks that expect firms to have robust systems and controls in place to manage conduct risk and to treat customers fairly. Proactively identifying and addressing systemic issues demonstrates a commitment to good conduct and customer protection, which is a core principle of market conduct regulation. An incorrect approach would be to solely focus on the volume of complaints without analyzing their nature or trends. This superficial analysis might lead to addressing individual complaints without tackling the root cause, meaning similar complaints will continue to arise. Another incorrect approach is to dismiss a cluster of similar complaints as isolated incidents without further investigation. This fails to recognize potential systemic weaknesses and could result in significant regulatory breaches if a pattern of misconduct is overlooked. A further incorrect approach is to only analyze complaints that have escalated to formal disputes, ignoring the vast majority of informal feedback that could signal emerging issues. This reactive stance misses opportunities for early intervention and remediation, potentially leading to larger problems and greater customer detriment. Professionals should adopt a decision-making framework that prioritizes a data-driven, proactive approach to complaint analysis. This involves establishing clear categorization criteria for complaints, regularly reviewing complaint data for trends and patterns, and having a defined process for escalating identified systemic issues for investigation and remediation. The framework should also include mechanisms for feedback to operational areas to prevent recurrence, and for reporting to senior management and the board on conduct risk and complaint trends. Question 19. The control framework reveals that the firm's compliance department has identified a pattern of unusual trading activity in a specific security by several employees shortly before a significant company announcement. The announcement, which is still confidential, is expected to have a material impact on the security's price. The compliance team is considering how to best address this situation to ensure adherence to market conduct principles and regulations. Which of the following represents the most appropriate course of action for the firm? Option A. Rely on the upcoming external audit to identify any instances of market abuse related to the confidential announcement. Option B. Issue a general warning to all employees about the importance of market conduct and the prohibition of insider dealing, without specifically investigating the recent trading patterns. Option C. Immediately initiate a detailed internal investigation into the trading activity of the identified employees, cross-referencing their trades with the timing of the confidential announcement and any known access to MNPI, while simultaneously reviewing the firm's surveillance systems for any potential weaknesses. Option D. Suspend all trading activities for any employee who has had access to the confidential announcement until the announcement is made public. The correct answer is C. Immediately initiate a detailed internal investigation into the trading activity of the identified employees, cross-referencing their trades with the timing of the confidential announcement and any known access to MNPI, while simultaneously reviewing the firm's surveillance systems for any potential weaknesses. Explanation. This scenario is professionally challenging because it requires a firm to balance the need for efficient market operations with the fundamental obligation to prevent market abuse. The firm's compliance department must exercise careful judgment to identify and address potential insider dealing without unduly hindering legitimate trading activities. The core tension lies in distinguishing between suspicious activity that warrants further investigation and normal market fluctuations or information dissemination. The correct approach involves a proactive and systematic process of monitoring trading activity against known material non-public information, MNPI, and promptly escalating any identified red flags to the relevant internal teams for thorough investigation. This aligns with the Market Abuse Regulation, MAR, in the UK, which places a strong emphasis on firms establishing systems and controls to detect and report suspected market abuse. Specifically, MAR Article 16 requires competent authorities to be notified of suspected insider dealing. The firm's obligation is to have robust surveillance systems in place and to act diligently when suspicious patterns emerge. This approach ensures compliance with regulatory requirements, protects market integrity, and safeguards the firm from potential sanctions. An incorrect approach that involves ignoring suspicious trading patterns simply because they do not definitively prove insider dealing is a significant regulatory and ethical failure. This demonstrates a lack of diligence and a failure to implement adequate systems and controls as mandated by MAR. It exposes the firm to the risk of facilitating market abuse and failing in its duty to report suspected breaches. Another incorrect approach, which is to immediately halt all trading by any employee who has had access to potentially sensitive information, is overly broad and can be commercially damaging. While caution is necessary, such a blanket restriction without a proper investigation into specific trading activity and its correlation with MNPI is not proportionate and goes beyond the regulatory requirements. It can stifle legitimate trading and create an unnecessarily restrictive environment, failing to strike the right balance between compliance and business operations. A further incorrect approach, which is to rely solely on external auditors to identify potential market abuse, abdicates the firm's primary responsibility. While external audits are valuable, the day-to-day responsibility for market conduct management and the implementation of surveillance systems rests with the firm itself. This approach indicates a failure to embed a culture of compliance and a lack of ownership over market conduct risks. A professional decision-making process for similar situations should involve a clear understanding of the firm's regulatory obligations under MAR, including the duty to monitor, detect, and report suspected market abuse. Professionals should utilize a risk-based approach, focusing on the likelihood and impact of potential market abuse. This involves having well-defined procedures for trade surveillance, clear escalation protocols for suspicious activity, and a commitment to thorough and timely investigations. When in doubt, seeking advice from senior compliance personnel or legal counsel is crucial. The ultimate goal is to maintain market integrity while enabling legitimate business activities. Question 20. The risk matrix shows a high likelihood of customer complaints related to perceived overcharging for basic account services. The firm is also seeking to improve its profit margins. Which of the following approaches best balances the need for profitability with the imperative to avoid exploiting customers? Option A. Introduce a mandatory annual service fee for all account holders, regardless of account activity or balance, to cover general operational costs. Option B. Conduct a comprehensive review of operational workflows to identify and eliminate inefficiencies, thereby reducing the cost of service delivery without compromising service quality or increasing customer-facing charges. Option C. Increase the commission rates for sales staff on all product sales, incentivizing them to push higher-margin products to customers. Option D. Implement a tiered fee structure for account maintenance, with higher fees for accounts with higher balances, justified by increased administrative complexity. Correct answer is D. Implement a tiered fee structure for account maintenance, with higher fees for accounts with higher balances, justified by increased administrative complexity. Explanation. This scenario is professionally challenging because it requires balancing the firm's financial objectives with its fundamental duty to treat customers fairly and avoid exploiting them. The inherent tension lies in identifying and implementing strategies that enhance profitability through efficiency and value creation, rather than through practices that could be perceived as predatory or unfair. Regulatory frameworks, such as those governing market conduct, emphasize that profitability should not come at the expense of customer well-being or trust. This necessitates a deep understanding of customer needs, product suitability, and transparent communication. The correct approach involves optimizing internal processes to reduce operational costs, improve service delivery, and offer products that genuinely meet customer needs at fair prices. This might include streamlining onboarding, enhancing digital service channels, or developing more efficient product design. Such strategies align with regulatory expectations by demonstrating a commitment to providing value and fostering long-term customer relationships, which ultimately contributes to sustainable profitability. Ethically, this approach upholds the principle of fairness and avoids any semblance of exploitation. An incorrect approach that focuses on increasing fees for services that are not demonstrably enhanced or are essential for basic account functioning would be professionally unacceptable. This could be seen as an attempt to extract additional revenue without providing commensurate value, potentially leading to customer dissatisfaction and regulatory scrutiny for unfair treatment. Another incorrect approach, such as aggressively cross-selling unsuitable or overly complex products to vulnerable customers to meet sales targets, directly contravenes the principles of customer suitability and fair dealing, risking significant reputational damage and regulatory sanctions. A third incorrect approach, involving the reduction of essential customer support services to cut costs without adequate alternative provisions, could also lead to customers being unable to access necessary assistance, thereby failing to meet the firm's duty of care and potentially breaching market conduct rules. Professionals should approach this by first conducting a thorough review of existing processes to identify areas for efficiency gains that do not negatively impact customer experience or product value. They should then assess potential revenue enhancement strategies against the firm's ethical commitments and regulatory obligations, prioritizing those that offer genuine customer benefit. A robust internal governance framework, including clear policies on pricing, product development, and customer interaction, is crucial for guiding decision-making and ensuring that profitability goals are pursued responsibly.